Hi everyone, welcome back to another video on this channel. My name is Nakul Anand, and in today's video, let's go through the concept of dividend investing. I'll start with the two main reasons why I think dividend investing is so important, and then after that, I'll go through everything you need to know about dividend investing. What dividends are, why companies pay dividends, the key financial metrics related to dividend investing, and the key considerations while investing in dividend stocks. At the end of the video, I'll go through my personal favorite dividend investment, so stick around for that and let's get started. Dividend investing, as some of you may know, is a method of buying stocks that pay dividends in order to receive a regular income stream from your investments. Dividend investing helps you build up your passive income and it diversifies your earnings by adding a new income stream. Let's go through each of these. What building up your passive income means is, unlike your active income, also known as your salary, which you're actively earning by spending hours at work and getting an hourly wage, once you start dividend investing, income comes in regularly without you putting in any time. While it's definitely important to have an active income stream, there's only so much income you can build doing that since you have limited time a day. Building passive income streams which don't require your time is a great way to build additional wealth. Diversifying your income is equally important because if you only have one source of income, you're reliant on it. If due to unforeseen circumstances you lose your job, well then you have no other sources of income to fall back to. Diversifying your income is just like diversifying your portfolio. You're spreading your risk across different sources of income, so if one source of income isn't doing too well, you can rely on other sources of income. Though there are more benefits of dividend investing, these are the two main reasons why I think dividend investing is so important. So let's dive into everything you need to know about it. Let's take a couple of minutes to really understand what dividends are. Dividends are payments a company makes to the shareholders of the company from the profits it has earned. Most companies pay dividends quarterly, but there are some companies that pay dividends annually, semi-annually, or even monthly. When a company announces dividends, it looks something like this. Today, McDonald's board of directors declared a quarterly cash dividend of $1.38 per share of common stock, payable on March 15, 2022, to shareholders of record at the close of business on March 1, 2022. So first of all, dividends are announced in amount received per share. So in this case, for every share of McDonald's you own, you would receive $1.38 this quarter. The declaration date is the date on which the board of directors announces the dividend. The date of record is the day on which the company checks its records to identify the shareholders of the company eligible for dividends. The ex-dividend date is the trading date on or after which the dividend is not owed to a new buyer of the stock. The ex-dividend date is one business day before the date of record. So in this case, the ex-dividend date would be a day before March 1st, which is the 28th of February. So if you wanted to receive dividend, you would have to hold the stock before the 28th of February. The date of payment is the date you actually receive the dividend. So why do companies pay dividends? Suppose a company makes $1,000 in profit last financial year. Well, they can take that money and reinvest it into the company. For example, they could buy new machinery or increase their research and development spend. They could buy another business. They could reduce any existing debt they have on their balance sheet. They could buy back shares from existing shareholders. Or they could pay a dividend. Well, when companies have so many other options, why do some companies choose to pay a dividend? Well, there are two primary reasons. The first is they have no better use for the money. They don't think they could use the money to help grow the company, and so they would rather reward the existing shareholders by paying it back to them. The second reason is that dividends can be an excellent way of attracting income investors like us, since investors know they will have a recurring income regardless of what happens to the stock price. Knowing this though, companies try to make sure that if they are starting to pay out dividends, they're sure that they will continue to earn stable profits in the future so they can pay dividends to their shareholders consistently. Dividends are most common from well-established companies that generate a consistent revenue. You will typically see mature companies distributing dividends as they're past the growth stage and do not need to reinvest a lot of money back into the company. Don't expect high-growth tech stocks to distribute high or consistent dividends. Instead, think of companies such as Walmart, Johnson & Johnson, Coca-Cola, or McDonald's. Stocks of such companies are called income stocks and they pay regular dividends. If you buy a good income stock that has a proven track record of paying consistent dividend, it generally means you're investing in a company with a great, resilient business model that can withstand economic downturns and continue to reward existing shareholders. When you're looking at dividend stocks, you generally look at two key financial ratios. The first is the company's dividend yield. Dividend yield measures how much you're receiving in dividends compared to how much you're paying to buy the stock. For example, if a company has a share price of $100 and it pays an annual dividend of $5 a share, well then its dividend yield is 5%. Now naturally, the first thing most investors would think is the higher the dividend yield, the better. Unfortunately not. While high dividend yields are definitely attractive, it's possible they may be at the expense of the potential growth of the company. Every dollar a company is paying in dividends to its shareholders is a dollar that the company is not reinvesting to grow and generate more capital gains. And this may be a sign that management prefers not to reinvest back into the company given the lack of upside. This could also mean that the company won't be able to consistently pay out dividends in the future. And as a dividend investor, getting consistent dividend from your investment is very important. That's why it's important to look at the second financial ratio as well, which is called payout ratio. The payout ratio is a financial metric showing the proportion of profits a company pays to its shareholders in the form of dividends. For example, if a company earns $1,000 in profit last financial year and they distribute $500 back in dividends to the shareholders, well then the company's payout ratio is 50%. When you look at payout ratio, what you want to make sure is the company's payout ratio is not increasing over time. Because an increasing payout ratio indicates that over the long term, the company's current dividend is not sustainable. Some companies have a payout ratio of more than 100%, which means that the company is paying more in dividends than it's generating in profits. Generally, when you're investing in an income stock, you look for companies with a stable payout ratio. So to recap, a good dividend stock is a company that has a relatively high and consistent dividend yield and a stable payout ratio that is not increasing over time. So what are the key considerations while buying dividend stocks? Well, the first and most obvious risk is that a company could stop paying dividends at any time. A company can change how much they're paying in dividends or stop paying dividends at any time. So even if you invest in large established companies that have paid consistent dividends, this is still a risk. For example, after 40 years of paying dividends, Disney stopped paying dividends in 2019 and haven't reinstated their dividends since. So as a dividend investor, when our primary aim is to get consistent income from our investments, one thing we should ensure is that we don't hold a large portion of a few stocks in our dividend portfolio, even if these are large names, because any company can stop paying dividend at any time. And yes, we could sell that stock and rebuy another dividend stock, but the company's share price could have fallen and we might not want to sell at a loss. So we would end up continuing to hold this company even though it isn't paying dividends. The second key consideration is that at the end of the day, the return we're getting on our investment is a combination of capital gain, which is the amount the share price is increasing by, and the dividends we're receiving from the company. And though a consistent dividend is amazing, we need to be careful that we're investing in companies that are growing or at least maintaining their share price to ensure we're not losing our capital invested while receiving regular dividends. So when we look at what companies we can invest in, I would recommend looking at Dividend Aristocrats. These are companies in the S&P 500 index that have paid and increased their base dividend every year for at least 25 consecutive years. So these are large established companies because they are part of the S&P 500 and they've paid consistent and increasing dividends over the last 25 years. It includes companies such as Coca-Cola, Pepsi, McDonald's, Walmart, and Johnson & Johnson. But again, as mentioned earlier, I would be cautious about investing only in a few of these companies, because at the end of the day, any company can stop paying dividends at any time. I would strongly recommend, instead of trying to pick a few of these dividend aristocrats, you can look at my favorite dividend investment, which is the ProShares S&P 500 Dividend Aristocrats ETF, which invests in all 65 of the current dividend aristocrats and has a net expense ratio of just 0.35% and an impressive 5-year annualized performance of 13.43%. This ETF has a dividend yield of 2.2% and will continue to monitor and remove any of its holdings that stop paying dividends, which will ensure you get a passive income while holding a diversified basket of large established income stocks. Additionally, and most importantly, since its inception, this ETF has not only provided consistent dividend, but strong price return as well. If you're looking for more investment ideas, keep a lookout for my video on the top 5 dividend ETFs to buy in 2022. I hope you found this video useful. If you did, do smash the like button. Let me know in the comment section below if you own any dividend ETFs. I'll see you in the next one.